Explain the factors to be considered while assessing the taxable income from house property. Point 1. Chargeability under Section 22. Income from house property is chargeable to tax under Section 22 of the Income Tax Act 1961. It applies when the assessee owns a building or land appurtenant thereto and the property is not used for business or profession carried on by the assessee. Point 2. Ownership of property. To tax income under this head, the assessee must be the legal owner of the property. Ownership includes freehold, leasehold, deemed ownership as per Section 27 or ownership under inheritance. Co-owners are taxed for their respective shares in the property. Point 3. Property must consist of building or land appurtenant. The asset must be a building, residential, commercial or industrial, or land attached to it like garden or parking space. Vacant land without any construction does not qualify under this head and is taxed differently. Point 4. Use of property. If the property is self-occupied, its annual value is taken as nil subject to conditions. If let out, the actual rent or expected rent, whichever is higher, is considered as gross annual value gap. However, if used for business or profession by the assessee, no income is charged under this head. Point 5. Determination of gross annual value gap. Gap is the reasonable expected rent the property can fetch. It is calculated based on municipal valuation, fair rent and standard rent, if applicable under Rent Control Act. In the case of let out properties, actual rent received or receivable is compared to expected rent to determine gap. Point 6. Deductions under Section 24. Once gap is determined, the Act allows standard deductions. Point 1. 30% of net annual value as a flat deduction for repairs and maintenance. Point 2. Interest on borrowed capital for acquisition, construction, repair or renovation up to rupee 2 lakh per annum for self-occupied property and actual interest amount in case of let-out properties. Point 7. Treatment of unrealized rent and vacancy. If rent could not be realized despite the owner's reasonable efforts, unrealized rent may be excluded from gap under Rule 4. Similarly, if the property was vacant during part of the year resulting in lower actual rent, the actual rent received may be considered as gap. Point 8. Deemed ownership, Section 27. In certain cases, a person is treated as a deemed owner, even if not legally the owner, such as transfers to spouse or minor child without adequate consideration, holder of an impartible estate, or buyer under par performance of a contract, Section 53A of Transfer of Property Act. Point 9. Self-occupied vs. let-out property. The Income Tax Act differentiates between self-occupied property. Maximum of 2 properties can be treated as self-occupied, others are deemed let-out, and let-out property. The entire treatment of annual value deductions and net income depends on this classification. Point 10. Composite rent and inseparable letting. If rent includes charges for both building and services, example lift security, and these are inseparable, the entire income may be taxed under income from other sources or profits and gains of business, depending on the case. If separable, only rent from building is taxed under house property. Conclusion. Assessment of taxable income from house property involves examining factors like ownership, nature of use, rental income, annual value, and eligible deductions. Section 22 to Section 27 collectively govern these aspects. A proper classification of the property and adherence to rules regarding valuation and deductions are essential for accurate computation of taxable income under this head.